All right, folks. Well, thanks everybody for joining us this morning. We are continuing our In the Trenches series. Today we're talking about loan and account modifications, and we've got a very diverse group of folks on the phone, everyone from auto finance to student loan finance to traditional banking institutions to mortgage lenders. And so we're going to try to cover a fairly top-level review of what types of modifications are available, what we're seeing within the different industries, as well as talking about what is or is not a permitted modification that's either done with or without the consumer's consent. So as we think about what it is we're going to talk about today, here's our basic outline that we're going to move through, which is some basics about account and loan modifications. We'll hit on two of those specific industries, and the reason we're focusing on auto lending and student lending is there are some unique issues that have developed because as of now, those are two industries that have not received governmental scrutiny or governmental guidance on modifications in response to the COVID-19 crisis. And so there are some unique considerations that come when we build private modification programs, including some that we'll talk about in detail with Craig regarding TDRs and troubled debt restructurings and how you're classifying these particular types of assets. We'll then move into some of the programs under the CARES Act that have become so very important in the last 2 weeks. We'll then shift over to talk a little bit about mortgage, both under the CARES Act and otherwise. And then we'll conclude by talking about some regulatory considerations. This week, we're going to do it the way we typically do, which is the presentation today is roughly 50 minutes. We'll allow 10 minutes of open questions. There's two ways you can send us questions. You can either send it as a chat, and you can choose to send it just to the organizers and panelists. You can send it to everybody who is out there who could see it, but if you want to do it anonymously, you can send it just to the organizers and panelists. And we'll also unmute the microphones, and you're welcome to pose questions to us as well. And you can do that anonymously, or you can identify what your institution is. We've got three people who are going to be presenting today. Obviously, this is Brad Rustin. I've been working with you on these In the Trenches along with my colleague, Craig Nazzaro, who is also in our financial regulatory practice, who comes from a pretty significant amount of time spent in-house working with some of the largest banks and then non-bank facilities in the U.S. And then today we're also joined by one of my colleagues, Carmen Thomas, who is one of the leaders of our Consumer Financial Services Group, and she has traditionally focused her practice on CFS litigation, CFS special workouts, and advising clients on state and federal compliance associated with doing consumer loan modifications, consumer loan litigation, and consumer loan workouts. So as we talk about today, here's why we think this is so important. And unfortunately, I updated the chart to reflect the unemployment rate as announced this morning by that came out about 9:30 a.m. this morning. What we see is whether we're talking about consumer cards, consumer installment, consumer real estate secured, auto lending, they tend to track with unemployment. And so this is a 10-year graph that we assembled last night. If you look about 30 years back, it tends to mirror. Certain move more closely. Cards tend to move very closely with unemployment, whereas your real estate tends to have other factors to drive it. But what we see is at the far right is the unemployment rate as of today. Most folks predict that with the additional 6 million unemployed, that unemployment's going to probably be somewhere in the 10 to 12% range as of today, and most economists are predicting about 15% by the time we kind of work through the recession here. That said, if historical trends prove true, we could be looking at approximately 15% of our consumer loan products having some sort of impairment, whether that's cards, whether that's consumer installment, real estate secured, et cetera. All of those are going to be presumably tracking behind that. What we're going to start with today is some just basics about how you run your loan and account modification programs. And what we've done is created a little bit of a checklist here for you, and that is understand that as you build your program, be very cognizant of how you're communicating with your borrowers or your account holders. Make sure that you have centralized control of those systems so that you're not having problems where individuals are doing this on a one-off basis without unified communication, and make sure you're having that central review. is the appropriate tone being used? We've seen some of our lenders and banks getting in trouble, and credit unions when they tend to talk too much business and not express an adequate level of concern for their members, customers, or borrowers that they're working with. And then also, we'll talk about this later with some of the ECOA or fair lending issues associated with modification programs is, are you educating your borrowers? Are you educating your account holders about what's available, making sure it's available to everyone, and making sure that you have consistent, not only communications, but a consistent means of communicating it out to the impacted customers. Then make sure that you're creating clear guidance for approval and eligibility. Make sure that even though we're trying to do everything very quickly, trying to respond dynamically to this crisis that we're all facing right now, we need to be very careful that we're not walking into regulatory issues 6 months from now because we have different eligibility where we're if anything, the Bank of America class action that was filed related to the PPP loans programs gives us a little guidance on that, which is already plaintiffs' firms are looking to file class action lawsuits when you're making products available either not uniformly or you're trying to preference certain key borrowers or key relationships of your bank or institution. And then make sure you're running all of this through your centralized controls. And Craig, a little bit later on, will talk about some of those unique fair lending issues. Make sure, because of the stress and, in essence, the panic that so many borrowers and account holders are facing right now, make sure we're providing clear communications of what this process entails. Make sure you have ways of keeping individuals up to date. We've been building a lot of PPP programs here lately, and that same issue comes up. How are you going to let those potential borrowers know when their application needs additional information? How are you going to document that? How are you going to work with them to communicate what the timelines and expectations are? And then make sure that you have a way to collect this data. Many of us are struggling right now, particularly if we were storefront lenders or we worked largely in a branch or face-to-face environment, or maybe if you're an indirect lender where you're working with people who tended to apply or communicate in person at a merchant or a dealership for auto lending, where we don't have really effective portals for customers to submit data into us. With that being said, if you're not doing it, make sure you have a team that's thinking about how are we going to communicate with our borrowers or account holders? How do we get information from them to determine their eligibility? And how are we going to have them sign these agreements? And then most important, always consider what the different options are, whether we're talking about payments, applications for modifications, forbearance applications. What are ways that you can collect this either online, electronically, telephonically, and then making sure you have controls around that. We've seen a lot of people in the last week getting in trouble with, reaching out to borrowers saying, hey, we'd like to help you. And maybe the borrower is sending emails in to a banker or a customer service rep at a lender. And then they're also faxing things in. Then they're also potentially using a portal to submit information. Are you tracking that and keeping it all centralized? We talk about what we can do. And we'll work through these fairly quickly, but a few just kind of overall what it is you can do to help these customers, what's currently being used in the industry. As you think about your accounts, some of the things you can do very quickly are, can you increase APY on deposits, meaning you would increase their rate? A lot of banks are offering overdraft fee waivers because people are having a lot of issues right now with their cash flow and are having overdrafts. Make sure you're thinking through whether or not you want to do ATM fee waivers, since so many customers are now being pushed over to using ATMs. A lot of banks, credit unions, and other financial institutions are eliminating minimum balance, and then offering either no fee courtesy overdraft or reducing the fees they charge for courtesy overdraft. Now, one big thing to remember here is if you are a financial institution, you're offering overdraft services, remember Reg E still applies. So even if you go to a free courtesy overdraft service, which some banks and credit unions have done, you still cannot turn on Reg E, meaning electronic access devices. So debit cards, in essence. You can't turn on debit card overdrafts unless the customer or member has affirmatively opted in to into a Reg E opt-in, meaning they've said, please turn on courtesy overdraft for electronic payment or electronic transactions. On the loan side, we've seen a lot of efforts to try to help people during the crisis, whether that's interest rate reductions, fee waivers. And one of the things we're going to talk about is a lot of the programs that our banks and credit unions are calling us to talk about, and our lenders are skip-a-payments, term extensions, renewals, lease extensions, and refis. All very important, all critical that we get those out into the industry, that we're making those available to our customers. But be aware there's some nasty pitfalls you can run into there, such as if you do a skip-a-payment, it's then going to affect some of the disclosures that you gave that customer, and are you documenting those to the customer so that they can't come back later and say, well, you know, you told me you were going to extend the term, but I didn't realize that would cause my total amount financed to go up, or it would effectively increase the term, so I was paying finance charges more. You know, when we help those delinquent borrowers, there's a lot of different programs out there that we'll talk about in a little bit more detail, but this is really just a checklist for you. One of the things we post on our website, and I've actually got the link here in the presentation that'll be sent to all the participants today, is be aware there's a whole series of federal regulations that change or impact what it is you can and can't do with either deposit accounts or different types of consumer loans. Sometimes it will require the consent of the borrower, or sometimes it'll actually trigger redisclosures. And so we have, and here's the link on our website, a chart that has a complete chart of all the various changes that may be applicable, and you can use that as kind of a quick reference guide as you're thinking through those. You know, whether it's a consumer lease, a consumer unsecured loan, a secured loan, there's information on what you can change on open-end credit programs, all that may be useful and a resource for you or your institution as you're thinking about this. Another thing we've put here in the presentation that may be of value to you is this is our quick internal chart, which is our rule of thumb for how you do account or loan modifications. And it's in essence a yes/no chart, and it helps get you to, does it require redisclosure? Does it require consumer consent? Or could it be done unilaterally without the consumer's consent? Again, these will be provided to all of you after the presentation today, so feel free to use those as a resource as you start coming up or developing your programs to try to help impacted consumers. Let's start with auto lending. This is perhaps one of the biggest areas that has not received federal attention yet through the various programs. You know, so many people are impacted by this right now, and as of today, there is not a federal program to help impacted auto borrowers. But, you know, as you think about, if you're doing auto lending, whether you're a direct lender like a bank, credit union, or lender, or you're doing indirect auto finance, or a finance company that's working through dealer networks or merchant networks, excuse me, make sure you follow these tips as you're building out these resources. And it tends to mirror what we talked about earlier, but you know, how are you going to advise people? And one of the biggest issues we see, and this is just something to plan for, is how do you avoid scams? We've already seen with a lot of the large auto finance companies a huge influx in fraudulent activity, where people are reaching out because they can sometimes find this online because of public lien databases. And they'll get, in fact, I got one yesterday, fraudulent email saying this is such and such financial services. Would you like to skip the next payments on your auto loan? If so, click here and provide this personal information. And a lot of people are being, you know, candidly duped by that right now. So make sure you have those protections in place, but it also means make sure you're communicating appropriately with your borrowers so that they know what is the real message that is being communicated if you're going to offer these types of relief programs. And we have here in the middle of the screen some of those that we've either helped put into practice or seen in the industry. Some can be as simple as just due date changes. Others are slightly more complex. How do you do payment deferrals and late fee waivers? Most of these, such as the late fee waivers, can be done unilaterally. Expediting title and lien releases can be done unilaterally. Most payment due date changes, depending on some issues of state law, can be done without or at the request of a borrower without new documentation. But one of the big things to think about is, as you think about eligibility, make sure you understand that you've got to have a clear matrix of here's who's eligible and here's what he or she receives. If not, you then put yourself back into that fair lending nightmare where certain customers were getting certain programs, certain customers were getting additional benefit, and you potentially have scrutiny 3, 6 months, 12 months from now, coming back in and looking at who you are offering that to and was it potentially impacting members of protected classes. Yeah, a few other considerations. Biggest issue we've seen with our auto finance clients is how do you build different payment options, and then how are you communicating that to borrowers? Do you have the capacity to go over to prearranged ACH, working with a network of money transmitters like Western Unions and MoneyGrams? Can you put in place e-checks, check by phone? What other ways are there that you can turn on fairly quickly to allow your borrowers to continue to make their payments when they're able to? One of the big pitfalls for auto finance that we've seen is with warranty extensions and add-on products. Almost every finance company is offering term extensions, and that's the captives all the way to the independent finance companies. But oftentimes there's not clarity as to what the impact that will have on warranty extensions, or if there are add-on products, are those also being extended? If they're not, we need to be very clear with our customers that those are not being impacted. Meaning if you have something like a gap insurance, or you've got a credit life, credit disability that had a set term, without consent from that insurance company that's providing it, oftentimes those will not extend if the underlying loan obligation or lease obligation is extended. Similarly, if you have people when you're doing new car finance, you can also run into that where the warranty on the vehicle is expiring, but their lease term has now extended, or their financing term has extended. We'll talk about FCRA a little bit later, but be aware there are some significant issues with credit reporting and collections and how you're going to be reporting it. That's one of the provisions of the CARES Act that does apply, and we'll talk about that a little bit later on. Another group of folks we have on the phones who want to specifically throw some information at you is a group of student lenders. Obviously, the Department of Ed has taken very affirmative steps to try to deal with the federal programs, those that are the direct loan programs owned by the federal government, and those have included these collection order stops, wage garnishment stops, as well as setting the interest rate on those loans to 0%. CARES Act put in place some additional protections for borrowers of federal student loans with a 6-month payment suspension as well as no interest accrual. None of this applies to private student loans. And the only issue so far that we've seen come up is the CARES Act credit reporting restrictions do apply to private student lenders. But we've given you a little sampling of what's available out there. Craig in a bit is going to talk about what happens when you start doing some creative extensions and modifications and some pitfalls that we've seen people fall into when you're doing term extensions, when you're doing forbearances, particularly if you're capitalizing those payments and the interest and then moving them over and having them then in essence add to the principal balance of the loan. That applies whether it's a student loan or not, but it's particularly true here. We're also going to talk a little bit about that TDR issue later. There's some challenge regarding whether or not you have to now classify these modified loans as troubled debts for accounting purposes. And we'll talk about some guidance that's come out that's given some relief to lenders and financial institutions when they're trying to work through the COVID-19 crisis that we'll get into a little bit later on. So with that, I'll turn this over to one of my colleagues now to talk a little bit about mortgages.
Thanks, Brad. So we wanted to also touch on what we're seeing in the mortgage space, particularly just like we did in student and auto. So this came out, this is a survey by the MBA that was completed and released on Tuesday. And it gives some line of sight or some insight into the wave that's coming for mortgage default and forbearance agreements and any loss mitigation request. Third bullet point down from the first, or the fourth bullet point down, you can see that it grew almost by 2,000% from the start of March through April 1. And the last time we've seen anything growth like this in the default space or the loss mid space would have been 10 years ago coming out of the financial crisis. So we can kind of see what's coming, and you start to see it here. The call center volume, hold times increased 17.5 minutes. Abandonment rates grew, and when you start to see that, you'll start to see complaints grow within your mortgage servicing silos. And when you see the complaints grow, you'll start to see the CFPB focus on this. So you can see what's coming right now, and also where the growth is being hit the most. It's independent mortgage banks is the highest, 3.45. Depositories at 2.24. An average of almost 3% is in forbearance right now. Brad, if you go to the next slide. So knowing that's coming, what can you do now? This is a little bit focused on mortgage here. So we want people to start focusing on their call centers to mitigate the regulatory risk later. You want to assess your call center staffing and volume capacities now, not when it gets those hold times and the abandonment rates go through the roof. And you want to be tracking your hold times and your abandonment rates just so you can be proactive, and it's part of your CMS. You want to look at the scripting, the QA and QC functions that are deployed with your call centers, and just general compliance controls that you have around this first borrower contact point. And also, you want to determine, document, and train staff as to what loss mitigation options are out there. Brad touched upon this in the beginning of the presentation, but the last thing you want to do is have people answering the phones and be the first point of contact for your customers, and them saying they think that this loan is available, or within mortgage, if they're looking at an investor guideline, they don't really know who owns their mortgage. You want to avoid all those issues. It turned into a nightmare scenario 10 years ago, and you know how it's going to play out, so it's time to start focusing on those areas. Second update here, you want to update your complaint program to account for escalated issues, so you know what are going to be hot topic high-risk areas in the coming months. You know, SCRA allegations, reputational risk, UDAP violations, fair lending violations within servicing. You might want to take a look at your complaint program and see if those are now tagged as escalated issues. So those are going into your legal department, your compliance department, just for a secondary review. Like if someone says they're active duty, you want to make sure that complaint is heard. We saw many banks 10 years ago, you know, not looking at those complaints that they were coming in, or not centralizing them in any manner, and paying a large price for that as you moved away from the crisis. You want to review the frequency and scheduling of certain monitoring and testing reports. So if you had a schedule that you started 2020 with, you might want to review what you're looking at from a compliance perspective. Maybe refocus on debt collection, refocus on credit reporting, and try to strengthen any gaps that you have found there, or you know, identify the gaps now rather than wherever these monitoring and testing reports would have fell in your schedule, or if they were even on your schedule for this year. But now it's time to refocus that. You also want to start documenting and reporting to your board and senior management just how the compliance department, the legal department, the risk department in general is going to account for this operational risk, how you're aware of the compliance risk that's coming and what you're deploying to control it. And conversely, if you are senior management or happen to be a board member on one of these calls, you want to make sure that you're asking in the next risk committee meeting or the next compliance meeting how the institution's handling it. Anything that you can start to document now and start to craft that narrative that you were ahead of any issues that would arise is going to go a long way to mitigate any process breaks that occur, you know, that were uncontrollable. Brad, next slide. I think that's it for mortgage. Yep.
Yeah, this is Carmen Thomas. I'm going to cover what the CARES Act that the President signed into law on March 27th does for the loan relief process and credit reporting. The credit reporting touches on any kind of product, but the most significant, probably financial relief in the context of financial services, relates to mortgages. The CARES Act relief covers all federally backed mortgages, and there's a list there on the slide. That's about 70% of the mortgages in the United States, so that's a huge portion of the market. One of the components is the foreclosure and eviction moratorium that is in place from March 18th through May 18th. It's a 60-day time frame, and the start date is set in the statute. And during this time frame, You cannot start a new foreclosure. You can't proceed to a foreclosure judgment. You can't evict somebody based on a foreclosure. You can proceed with other things within the foreclosure, like if counterclaims have been asserted or other steps that need to be taken, but you can't start a new one or conclude one. This doesn't apply to properties that you can determine and document are vacant or abandoned. So if you have any of those, you can flag them to proceed, but you need to be sure that they are vacant or abandoned, and you would have normal procedures for doing that. Even subject to this moratorium, state courts across the country have, in most cases, done something to limit the ability to move forward on foreclosures during certain time frames. And if you want details about that, you can reach out to any of us. We've got been maintaining a list of that and of other court restrictions that affect financial services companies. Renters also cannot be evicted if the owner participates in a federal mortgage or rental assistance program, and the owner of a property can't charge fees, penalties, or other charges related to the person not paying rent. And that runs from March 27th to September 27th. That's a really long time. So during that time period, landlords won't be getting rental income, or at least renters are protected during that time frame. That means that they're probably going to seek relief too, and the law takes care of this and makes the foreclosure moratorium and the forbearance options available to multifamily housing, including multifamily that's 5 or more units, which is not really typical of these type of programs. All right, next slide. The forbearances that are authorized and required, actually, if requested, are the most significant financial relief available to consumers through the CARES Act. All they have to do is request the forbearance and some kind of attestation to having a financial hardship that's caused directly or indirectly by the COVID-19 situation. You can't require them to provide any other documents for them to be able to get this forbearance. They have a right first to 180-day forbearance, and then if they request it, they can have another 180 days. That is a very long time that the loan may be forborne from the borrower having to make payments. During that time period, you can only charge fees and interest as if the borrower was making the scheduled payments. So you can't charge anything as if they are delinquent or not making payments. Again, rental properties are eligible for this. One of the interesting things that we've been discussing is what happens after the forbearance. The forbearance can be, stopping payments totally, but they have to be made sometime unless you enter some other kind of arrangement, or it can be some kind of reduced payment. So you need to be thinking ahead to what options you're going to have in place when the forbearance ends. And the forbearance is going to end either at the end of these 180-day periods or at some earlier time if the borrower requests it. But there are a lot of factors that you have to consider, like what are the balloon payment terms and the documents for the mortgage or in the state, what and how are the interest rates affected, or amortization. There's a lot to think about, especially because these are going to be such potentially long forbearances. Escrow is another issue that we're working through, and I think are planning to have another webinar in a couple of weeks to talk about issues related to escrow during this time period.
And Craig, did you want to give some input on what you saw working in-house at one of the giant banks as you dealt with the recession in terms of, some of the issues that came up when you had these extended forbearance programs, and then what would happen at the end of that term?
Sure. So when you come out of these forbearance programs, it's a lot of the times you're doing it with good intention, like you're trying to help the consumer and you're feeling for their situation. But at the same time, you want to put an underwriting process around getting out of this forbearance and back into a performing loan. So if they're not going back into their regular loan, you are in fact modding the loan. you want to, set a threshold for where, they almost like a new ability to repay for the modification. What we saw in 2008, 2009, 2010 is you saw lenders, reaching to try to keep people in the homes. Sometimes you get a reputational risk in there. People can't go back to work. There's, certain people have certain challenges that you just want to be able to help them and remain in their home. But if you put them in a loan that they're not going to be able to afford, I've been in situations where various attorney general's offices or, in the resulting litigation, the bank will be cited for, just advancing them, kicking the can down the road. Whereas I've seen some regulators and some state AG offices, prefer to have the Band-Aid ripped off if you're going to put somebody in a loan that even a mod, that that they can't keep. You're going to eat through the equity, any equity that they have in that house, the longer you keep them in there and the longer they're in default. And a lot of regulators and a lot of state AGs don't want to see that. Other issues you're going to start to see is there's some state regulations, state rules around what you can do in a modification and how to record it within individual counties. For example, if you're going to do a recapitalization mod, recaps mods are in some states unallowable because you're not going to be securing that extra debt. Other states, you're going to run into problems with the term of the loan if you extend it out too long, depending on when an automatic release is required or a lien release is required. So it's good to focus on those issues when you come out of this forbearance period and kind of look down the road.
The feds have thought a tiny bit about this so far. There's a FHA or a HUD mortgagee letter that the FHA is allowing a partial claim to facilitate reinstatement at the end of forbearance periods, where the servicer advances part of the funding or all of the funding to reinstate, depending on the circumstances, and a subordinate mortgage is created, and it is not due until the first mortgage is paid off. Now, that hasn't been implemented at all, but there is this mortgagee letter out there that announces that this is an option. I don't know that anybody's going to be close to doing that yet, but that's something to think about. That'll need to be worked through too. All right, next slide. Another important part of the CARES Act that we've mentioned several times, because it comes up in every other lending product context, is the credit reporting. This is broader than mortgage. It applies to everything. And what it's also very broad. As you see here, you're approved for relief, and if you're current, then the furnisher, that's everybody who's providing the status of the credit information to the credit reporting agencies, you have to report it as current or up to date. The approved for relief category is any kind of relief. It's not just the forbearances that the CARES Act allows. It's if you defer one or more payments, allow a partial payment, a forbearance, modification, any other relief to a borrower related to the national emergency, you've got to report the loan as current. And that starts as of January 31st, 2020, which is in the past. So you've got to go back and check. If you start doing any kind of relief like this, you've got to go back and credit report as of that date forward. Now, when does that end? The law says at least 120 days after the national emergency ends. Well, that can also be a very long time. I think my research showed there have been 60-something national emergencies declared since that even became possible to do at the beginning of the 1900s, and 30 of those are still being annually renewed. It takes one of three situations to end a national emergency. The president can declare an end to it. Congress can pass a joint resolution, or each national emergency has to be renewed every year. So a year from now, it could be not renewed. But that means that you have to report these loans current until at least 120 days after the national emergency ends. So somebody has to be paying attention to that and make sure that the time periods are implemented in your systems. For delinquent accounts, you can maintain the delinquent reporting status, and if it's brought current, you can report it as current. All right, next slide. We've also considered what special relief or situations apply to our service members. On March 13th, the Department of Defense issued a stop movement order, which did exactly that. It ordered all military personnel and their families to stop domestic travel. There's another order for foreign travel, but that includes changing stations or temporary duty assignments. The Department of Justice issued an announcement a few weeks later on March 30th that discusses the stop movement order and its effect on military families, and also reminds the world that the Department of Justice has authority to enforce the Service Member Civil Relief Act. The effects that they described are that if service members were about to move, they can't do that now. So there may be closings or rental agreements or other things that were about to happen that cannot now end, or they cannot begin. So pay attention to that, and the normal Service Member Civil Relief Act provisions will apply. It is important, as mentioned earlier, to check status for people who may be active duty military. Otherwise, there has been no specific national emergency related relief for military families and service members. All right, next slide. We also have looked at guidance from the GSE, Fannie Mae, and Freddie Mac. They have been issuing lender letters, nothing specific to modifications, but addressing originations, appraisals, and servicing. There have been different documentation requirements. On April 8th, they issued some more specific temporary guidance answering questions that stemmed from these lender letters. Some of that relates to how income is updated. They previously allowed income to be updated or to be 4 months old. Now you have to have it within 2 months of age. You have to consider the deferred debt that a borrower may have through all of these other programs or arrangements with creditors. You have to consider that as part of the debt to income ratio. It's creating flexibility for appraisals because the appraisers cannot get out or go into the homes. They're allowing desktop appraisals and other sources of information for the appraisers to use. We were talking about this earlier and how this is so different than the financial crisis back in 08 and 09, where it's almost like it's going back to that, sort of previous situation, depending on documentation for appraisers. But that's just something to look out for and getting used to. And there's a lot more about this out on the internet in these specific guidances from these entities. Next slide. All right, Craig.
So Brad touched upon this earlier, the troubled debt restructuring or TDR designation for troubled loans. We are seeing some relief come out of the regulatory agencies. They've released the interagency statement on loan modification, where they've confirmed that any short-term modifications made on a good faith basis in response to COVID are not going to be considered TDRs. So the second middle of the slide here is how you can presume that borrowers are not experiencing financial difficulties when they need the modification that is outside of COVID. So if modification has to be short-term, 6 months or less, the borrower was current on payments at the time the modification program was implemented, and the modification is in response to the national emergency. So it seems to be counterintuitive because people are going to try to remain current as long as possible, but other people are going to see these programs being rolled out and believe that there's going to be help for them there on real estate mortgages, for example, and possibly default. So you're going to want to try to approach the modifications with urgency, because once those loans default, and if they remain defaulted and they're not processed, you're not going to be able to classify this as a COVID-19 issue or a Section 4013 loan under the CARES Act.
we've been seeing is certain lenders are really making a concerted effort to, as they're talking to borrowers, to document those borrower circumstances. Most of the major non-bank lenders now, as they have put in place their private programs, have as one of their eligibility criteria that you've got to be requesting this in response to the COVID-19 crisis, or some of the government shutdown orders, or the other kind of offshoot implications of the steps that have been taken to stop the spread of the coronavirus. And it's important, if you're going to do that, particularly if you're a non-bank lender, that you're documenting that through some process, so that in the event you do get some questions that come up later, you're in essence satisfying these bullet points in the middle of the slide here.
That's a great point, Brad. We're expecting kind of a relaxed supervisory process when it comes to the review of the loans that are addressed in the CARES Act. But, you know, I've heard that before from regulators, and then you're 2 years out and they're in your offices and they're looking at your portfolio, and you're going to want as much ammunition that you can get to kind of successfully make your argument. And the certification that Brad's talking about is the perfect idea. Like, it may not be required, but if you get the borrower to certify and you know, just have a document that lays out why this modification or why this loss mint pursuit is not a TDR is going to help you. And just from an overall perspective, the way the regulators are looking at this is that a majority of the loss mint that's going to come out in the next 6 months is not, and I don't know if they're correct in this, it's not based on the credit quality of the borrower. It's just a short-term effect of the social distancing and basically shutting down of the economy. So I don't know when that switch flips over and it actually becomes systemic to the economy, like what was a performing borrower or was a credit-worthy loan actually turns into trouble debt. The longer this goes on, obviously the longer the debt doesn't become a concern and does kind of need the risk rating in order to have an impact on the safety and soundness of your institution. But you know, that's going to be in the months to come as we see more come out from the regulators. Next slide, Brad. Community Investment Act. So the CRA credits. You can get CRA credit for the activity that you're doing in your loss mint areas. I have some points bulleted out here for what you should be looking for. What you're going to want to do is kind of track everything. You're going to want to create a repository of any loans that you're doing in response to COVID, and then start to build that into your CRA plan, and make sure that you're getting credit for everything you possibly can. You know, not only the changes to the modifications, but are you servicing loans for your community that may not be on your books, but forwarded or originated by your county or city or state? Are you doing any education on loss mint? Are you putting anything out there to help the borrowers? Get all of that aggregated. If you're a smaller institution and you don't have the CRA program of a larger one, you know, now's the time to kind of move your rating up. You can like hopefully go from satisfactory to outstanding, or you know, however your program is operating. This is an opportunity to kind of strengthen that. Next slide, Brad. Fair lending impact. We talked about this earlier in the presentation as well. So both the COA and the Fair Housing Act make it unlawful for lenders to discriminate, obviously, but that also includes the servicing of a loan and invoking any default remedies. A lot of people forget about that, or they look at fair lending mostly as an origination issue, but it's just as much a servicing issue, and especially a default issue, because when the regulators get in there, they see a extreme risk to consumers in the default space, so they look very closely at this. You're going to want to review any loss mitigation procedures and applicable waterfalls for possible disparate impact issues. Again, we saw this 10 years ago. You don't have any ill will towards the borrower or the protected classes, or you're not even thinking about it. But you do want, you know, a control there for somebody who's just focused on possible disparate impact to your population of consumers when you roll something like this out, just as you would with a new product. Any loss mitigation product is going to have the same impact. Another point I would like to bring up here for fair lending is the limited English proficiency issues. So whenever we see a uptick in default or you know, getting into a recession, you're going to start to see the regulators come out and look to see how you're originating these loans. Were you translating English documents at origination? Were you verbally translating them? Were you translating just some of the notes and just some of the mortgages? If you're translating or giving alternative English options to anybody within the origination channel, you want to absolutely make sure you do this in the default channel. It's going to be looked at as a fair lending violation if you're only doing it in their native language in your sales silos and not in your default and servicing silos. You can get away with it sometimes in your core servicing. Once it moves to default, you start to see the regulators harp on it. It's in the CFPB guidance and some of those quarterly oversight papers that they release. They are consistently focused on it and will be coming out of this move into the higher default rates.
And Craig, one thing you mentioned that I thought was really appropriate is if we have folks on the call who are doing servicing, where they're either buying loans or potentially servicing on either a white label or a truly purchased basis, there's some issues with that software being able to flag those loans that have that were closed based on LEP borrowers, and the ability to translate that over. I mean, you want to just touch briefly on that because I thought that was really insightful.
Sure. If you're not, I mean, most of us aren't the originator of loans that are in our MSR portfolios or servicing portfolios. If most servicing systems or a lot of core servicing systems don't have the ability to track language or what language the loan was originated in, so you really have no idea. You'd be servicing a loan that was, all the docs are in English, but they had a verbal translator at the closing. Someone calls into the servicer, not even with the ability to speak English and just speaking their native language, and you don't know what to do. You want to have a policy around that. Show the regulators that you've thought about this, and you thought that the best protection would be to not offer it, because if you offer just certain languages, what about those who speak other languages than the ones you offer? And you can start to go down a path where it's a double-edged sword. If you're helping one group and not the other, or did you have a program around how to determine which languages to offer? Did you look at the population of your footprint of who you're servicing and what are the most popular languages? So you want to document that before it becomes an issue or before a regulator finds it. Brad, next slide. I believe this is the last slide, so we're right about on time. Third-party oversight. One thing you also want to look at here as you start to see an uptick in default is your third parties. The two of them that are going to be of importance first is mortgage servicing vendors and debt collection vendors. So within mortgage servicing, if you're utilizing a private label servicer or a sub-servicer, did you give them delegated authority for your loss mid? Do you want to be more aware of reputational risks that are out there now that the default rates are rising? You have to look into your master services agreements, review your MSAs, see what you're doing, see if you have any loss mid out there or more loss mid guidance with your servicers to implement. You're going to want to start to look at that, what they're escalating up, if they're giving you their complaints. Do you want to see them on a more frequent basis now? Were they giving you the complaints and you just weren't doing anything with them? They're going to become more important as that default rate rises. Other vendors within mortgage that are going to become highly critical, not necessarily in the next month, but if the default rates continue to rise and loss mid options requests continue to rise, you're going to have to start looking hard at your property preservation vendors and your foreclosure vendors. Make sure that they've all been reviewed recently, that there's been no issues, that you've looked at them on an annual basis at least, or if they've been on board for a while and your TPO program isn't really up to snuff, you might want to get out there and start to look at it. Also, your debt collection vendors. As people start to default on their debt, the debt collectors are going to start to ramp up, and you're going to start to see a lot more complaints coming in through the CFPB about defaulted debt. Once those complaints start to come in, even if they're first-party complaints, they're not going to be FDCPA violations, but you'll start to see the CFPB or your primary regulators try to hammer you on UDAP issues. So you want to get ahead of that and start to look at your debt collection vendors or who you're utilizing for that task. I think with that, Brad, you can go to the next slide, but I think that's it.
Yeah, so in a second, we'll start taking questions, and we've had a few that have been sent in that we'll pick up here briefly. Before we shift into questions, I would encourage you, if you would like, we have obviously these sessions, these In the Trenches sessions every Tuesday and Thursday. Tuesday at 11 o'clock Eastern, we're doing a entire training session specifically on residential mortgage modifications and some of the offshoots of that. It'll be very focused solely on the mortgage space as opposed to general lending space. And then on April 16th, we're dealing with compliance management system updates and adapting your CMS policy to address some of these changes that are coming through so that you don't run into pitfalls with examiners or regulators when your CMS is not matching what you're doing in response to this particular, the coronavirus and COVID-19 pandemic response. Also, as I said, everyone who participated will get the copies of these slides as well as the link to the loan modification account modification chart that'll be coming around. Both of those are available on our website, as well as a recording of this is available externally if you'd like to reference anything that we discussed, or alternatively send it to anyone else at other institutions or your own institution. I did get some questions during the presentation. The first one I'll turn to Carmen and Craig for. One of our participants asked if the modification includes an extension of the maturity to account for the deferral, i.e. if they're doing a 90-day extension of the total loan, is it more likely than considered a TDR than if the deferment payments are simply adding to the existing maturity as a balloon? Meaning, is it safer to do balloons, or is it better to do a term extension as we think about whether or not it potentially is classified as a TDR?
It's Craig. I think there's no specific bright line test there that's been provided yet, but I believe what I think the regulators are going to start to ask if they look at it is what the credit quality was, or why you believe the credit quality was one where you shouldn't have to re-rate the risk weighting like you would in a TDR. So even if you're putting it back at the end of the term where you're putting a balloon there, I think if it starts to perform and maintains performance, there's no reason that you'd have to classify that as a TDR. That would be my argument.
And one of the big challenges we see, I think, with the balloons is just be very careful. Many states either limit your ability to create balloons. There are also potential regulatory pitfalls by creating balloons at the end. But the converse of that is be very careful in states when you do term extensions. A number of states either do not allow term extensions on a mortgage, or if you do extend it, it potentially requires you to re-record that modification so that the term isn't extended in the public record. And as we worked through the recession last time with a lot of our clients, we would get a lot of files in litigation where there was an extension, term extension in one of those states, and there was no modification recorded publicly. And arguably then a lot of those lenders had an unsecured debt for the extent of that term extension, meaning the mortgage or the lien on collateral had fallen off because it had expired according to the terms of the mortgage or the lien, but the debt had extended past that debt. So you can get yourself in quite a little trap there.
The other thing I'd add there, Brad, is balloons in general. I've had weird experiences with regulators with them, especially in a default environment where it's a high default. A lot of state regulators pushing back too, thinking that by putting the balloon there, you're basically, if the loan is close to maturity, you're limiting that consumer's ability to dispose of the property and to ever catch up. Like, there's no way they're going to be able to make that balloon payment if it's 2.5 years out, and they're most likely not going to be able to refi because they're in default now, and you know what their credit situation is going to look like in 2 years. I start to kind of contemplate all that too when I'm building the policies and procedures out.
Okay. Other questions, you can feel free to send those into the question portal. We're happy to answer those now. And as we say, we always are happy to stay on the line for about 30 minutes as well, so that you can ask your questions of the various presenters. And it can be related to today's topic or related to any other topic that you'd like. And so just fair warning, I'm going to unmute everyone's line right now. And, you're welcome to raise your questions here.
Brad, you want to stop recording?
Yeah, give me 1 second, and I will do that as well. Okay, recording should be stopped now.